money market funds have become one of the most popular investment options here in Kenya, and for good reasons. They are relatively accessible, they generally offer better returns than keeping money in an ordinary savings account, and allow investors to earn income without actively managing individual investments. For someone who wants to preserve capital while keeping their money relatively liquid, an MMF can be an excellent starting point. However, there is one important question every investor should ask. Is an MMF the best place for all your money? The answer is usually no. An MMF is designed primarily for short-term and relatively conservative investing. If your objective is to build substantial wealth over the next 10, 15 or 20 years, you may need investments with greater growth potential. So in this video, we are going to look at several alternatives to money markets or money market funds in Kenya. But before you get into it, make sure you like this video and also subscribe to the channel. It really helps a lot. The first alternative is Treasury Bills. This is probably the strongest MMF alternative for conservative investors. If you are putting your money into an MMF primarily because you want safety and relatively predictable returns, Treasury Bills deserve serious consideration. You earn money from Treasury Bills mainly because you buy them at a discount and receive the full face value when they mature. The Central Bank of Kenya currently issues 91-day, 182-day, and 364-day Treasury Bills, and recent CBK auction results show that the bills are currently sold at a rate of around 8.8% or between 8 to 9%. So this means for every 100 shillings you invest or you're willing to invest, you receive a discount of 8.8 shillings. This means you will pay around 91 bob, then receive 100 bob at maturity. So if you invest or you buy bills worth 91,000, the gross profit will be about 8,000. Now, why consider them? There are several reasons. First, government-backed instruments are safe and secure. Second, they have short maturities. Third, no fund manager deciding which securities to buy. And last one, you can match the security to when you need the money. So Treasury bills are best for emergency reserves beyond your immediate cash needs and short-term goals. And how do you invest in Treasury bills? You need CBK CDS account to invest directly in government securities. If you don't have an account, start by opening one. You can also invest through an authorized commercial bank or investment intermediary. Then after that, choose the T-bill maturity. Then decide how much to invest. Generally, you can invest a minimum of 100,000 shillings with an additional amount in multiples of 50,000. Then after that, apply during an auction. CBK conducts T-bill auctions regularly. You can submit a bid specifying how much you want to invest. If your bid is successful, you pay the amount required by CBK, and then what you have to do is to wait for maturity to receive the principal and your earnings, and you're good to go. The second alternative is Treasury Bonds. The securities market includes both Treasury bills and longer-term government bonds, with bonds available across substantially longer maturities like 10, 20 or even 30 years. When you buy a Kenyan Treasury bond, you lend money to the government of Kenya, and in return, the government pays you a coupon interest, usually twice a year, and the coupon rate often fluctuates, but right now the interest rate is about 12% annually. So if you invest 1 million, you will get 20,000 in 1 year. That's about 60k after every 6 months. And then upon maturity, you receive the principal. And a point to note, treasury bonds can make more sense when you're willing to lock your money away for several years. They can provide regular interest payments, unlike an MMF. They are best for someone building a portfolio for like 5, even 14, 15, or even 20 years. Imagine if you have money that you don't need for several years, instead of keeping all of it in an MMF, you could consider allocating part of your portfolio to longer term fixed income investments like bonds. But there is an important point many beginners don't understand. A bond isn't necessarily something you should buy and sell frequently. If you sell a bond before maturity, its market value can change depending on interest rates and market conditions. So bonds can make sense for investors who are comfortable committing money for longer periods. So to start or to invest in treasury bonds, you first need a CBK CDS account. If you don't have one, you need to open one. And you can also invest through an authorized commercial bank or investment intermediary. Look for the listed treasury bonds listed on the CBK website, either a new bond or a reopened bond. Then decide how much to invest. The minimum you can invest is 50,000. Then place your bid, and if your bid is successful, you enjoy your earnings through interest payments. The next one is dividend-paying stocks. This is where I would draw a major distinction. MMFs are primarily wealth preservation tools. Stocks can be wealth creation tools. When you buy shares of a company, you become a part owner of that business. If the company performs well, two things can potentially happen. First, the company may pay you dividends. Second, the value of your shares may increase. That's something an MMF does not provide in the same way. With shares, you are investing in businesses that have the potential to grow their profits over many years. Think about it. If you invest in a company that continues to expand its customer base, increase revenue, improve profits, and grow its market share, the value of your investment could potentially increase significantly over time. But there is a catch. Shares are much more volatile than MMFs. Your investment can fall, sometimes dramatically, and a company can reduce or completely suspend its dividends. So that's why shares should generally be considered a long-term investment rather than a place to keep money you will need next month. So I would not replace your entire MMF allocation with shares. Instead, consider using shares for the portion of your money you don't need in the next few years. And then we have growth stocks. These are companies that investors believe they have significant potential to increase their earnings and value over time. Some growth companies don't pay large dividends because they reinvest their profits back into the business. They are trying to expand, they are hiring more employees, they are developing new products, they are entering new markets, they are investing in technology. For a long-term investor, this can create significant wealth if the company succeeds. But again, the risk is higher. A company that looks promising today may fail to deliver tomorrow. That's why diversification matters. Don't put your entire investment portfolio into one company simply because you believe it's going to become the next big thing. The next one is starting or expanding a business, and this is perhaps the most overlooked alternative to an MMF. Suppose you have 100,000, putting the money into a conservative investment like MMFs might generate a relatively predictable return, but if you use the same money to start or expand a profitable small business, the potential return could be considerably higher, like 20% higher, 50% higher, or even 100% higher. You could, if you already have a business, you could invest in equipment, inventory, marketing, technology, or skills that increase your earning capacity. Of course, this is also one with the high risk. A business can generate exceptional returns, but it can also lose your entire investment. The difference is that you are not simply investing money, you are investing in an economic activity that requires knowledge, execution, discipline, and sometimes significant amounts of time. For this reason, business investment should only be considered after understanding the market and the risks involved. So, are money market funds bad? Absolutely not. They can be an excellent financial tool, but here is what I want you to remember. An MMF can be a great place to keep some of your money. It doesn't necessarily have to be the place where you keep all of your money. If you are investing for a short-term goal, liquidity and capital preservation may matter more than maximum returns. But if you're investing for the next 10, 20, or 30 years, you should at least consider investments that have greater long-term growth potential. Treasury bills, treasury bonds, shares, businesses, the right combination depends on your income, financial goals, risk tolerance, and investment timeline. So before you put your next 10,000 or 50,000 or even 100,000 into an MMF, stop and ask yourself one question. What job do I want this money to do? Because once every shilling has a purpose, you stop simply saving money and you start building wealth. If you found this video useful, please like this video and also subscribe to the channel. And thanks for watching. I'll see you in the next one.